Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market.
Welcome to Fixed Interest, Fitch Ratings podcast for global debt investors. I'm Aymeric Poizot, Global Head of Investor Development for Fitch Ratings, and today we are exploring innovation that is reshaping credit markets. From project finance to corporate-backed leverage, subscription lines, and NAV loans, the investment-grade credit landscape is evolving fast with new entry points for institutional investors. Joining me is Monsur Hussain, Head of Markets Research at Fitch Ratings. Monsur, let's start with the big picture. What's driving this wave of credit innovation, notably in investment grade?
Hello. We see three powerful forces at work. The first is access to capital. We're talking about an approximate $100 trillion pool of investor capital from insurance companies, pension funds, and an estimated 15 trillion from sovereign wealth funds. And this enormous pool is energizing what we call market-based finance. And these investors are increasingly in their driving seat, demanding match-funded, longer duration solutions that banks simply can't always provide. The second driver is the accelerating use of securitization tools and techniques, which act as a translation layer. On the one side, you have a vast growing stock of real economic assets, so mortgages, leases, and loans. On the other side, you have trillions of dollars of this institutional capital with very specific requirements. And securitization is that translation layer in between that makes these two sides speak to each other. The third driver is simply the sheer scale of digital and energy infrastructure financing needs that have overwhelmed traditional bank and public market channels. Of around 30 recent global transactions reviewed by Fitch, the smallest was around $1 billion, largest or worth in excess of $30 billion for single-site projects. And so due to this incredible need, what we're seeing is that private market lending is growing alongside a buoyant public debt market and ultimately creates net new assets for the rated ecosystem. And again, securitization is the mechanism at the center of that transformation.
That's definitely a remarkable skill. Quickly, where are the new, if you could take an example or two, where are the new structures and instruments emerging?
The corporate joint venture and back leverage structures our analysts are seeing are being deployed in a context that would have been unrecognizable even 10 years ago. The idea is to take a strategic asset from a corporate balance sheet and create an investment-grade cash flow stream that can be distributed to institutional investors. So you have a financial sponsor, an asset manager, enter into a joint venture with an existing industrial entity to finance this asset. The financial sponsor then issues so-called back leverage in the form of rated notes to fund this, usually rated investment grade, which makes it possible for funds and insurers to participate.
Thanks. And it's particularly active, as we see, in sectors with large identifiable strategic assets, as you said. I mean, large manufacturing facilities, infrastructure assets, data centers. But let's shift a bit. I mean, what about in the fund finance world? Tell us about the innovation we are seeing at fund level, not asset level.
Subscription line facilities and net asset value loans are being brought into the rated market for the first time due to the growing recognition that ratings can help banks better assess risk and, importantly, optimize capital allocation under the final Basel III prudential regime, alongside also unlocking broader institutional participation. We're also seeing rated note feeders, which are like the Swiss Army knives of the fund universe, where investors subscribe to tranched rated debt notes backed by private credit portfolios. Collectively, these give fixed income buyers a debt-like path into alternative investment strategies that were previously inaccessible to them.
Now, let me ask directly the question that sophisticated investors sometimes raise. What does this innovation at asset and fund level mean for risk management processes? And in particular, is there still a compelling use case for external credit ratings?
I'd point to the informational and credit benchmarking decision. Even for those sophisticated investors with credit teams comparable in capability to a rating agency, the opacity of private markets still pose a challenge for informed decision-making. Critically, credit ratings can help provide a common reference point that can help anchor valuation on spread curves. And as private credit seeks to develop into more transparent pricing mechanisms, that common reference point becomes more, not less valuable.
Monsur, final thoughts. What's the single most important takeaway for global investors today when talking about this or when thinking about this innovation?
I'd say institutional investors as I've mentioned, pension funds and insurance companies, are no longer just allocators. They're increasingly the engine of credit intermediation. By match funding an increasing range of credit assets, they're stepping into a role once dominated by banks and public markets. And for debt investors, that means a generally expanding opportunity set, but one that requires careful navigation of new structures, new risks, and new asset classes.
Monsur, thank you so much for joining us today. For listeners who want to dig deeper, Fitch has published a full suite of criteria covering everything we discussed today, from feeder fund debt, NAV finance, SRTs, project finance, digital infrastructures, and beyond. All are available on fitchratings.com/criteria. That was Monsur Hussain, Head of Market Research on Innovation in Credit Markets. Thanks for listening.
Subscribe to Fixed Interests wherever you get your podcasts.